This class is going to be another in our series for beginning traders. What is the minimum you need to know in order to trade? And the first step of trading is to decide what the proper amount of risk is per trade. New traders that have no idea what they're doing, and most of them don't. There's usually 50 to 100 things that you don't know, and you don't even know that you don't know them. The first thing you should be aware of is position sizing, money management. So in our toolbar, if you right-click on that, you have Trade Analyzer Planner. This Trade Analyzer Planner has a tab called Position Sizer. And if you put in how much your account size is, let's say 2,000, new traders that have no idea what they're doing should risk 1%. And the number of lots that you can trade is all dependent on the number of pips that your stop is. Most of our systems have an 8 to 12 pip stop. So we'll just put in 10 there. And this allows you to scale in for more advanced traders. You can watch our video online to learn all the advanced part of this. This video is going to teach a bunch of stuff, so I'm not going to go ahead and get into stuff that I've already done videos on. Click Calculate, and it tells you that with a $2,000 account, if you're risking 1% of your account, that's only $20. You can trade 2 mini lots with a 10 pip stop. If you have a 20 pip stop, obviously you're going to be able to trade half that amount, which is only 0.1 lots. If you, for some reason, believe that you can have a 6 pip stop, you can do 0.33 lots. And so the tighter your stop, the more lots you can trade while keeping the same risk percentage. Now, I would, once you become an experienced trader, most of the time risk 2% per trade. Let's put this 10 back here. And that means you can lose $40 and you can trade 4 mini lots. So if you catch a 30 pip win, then you'd make $120 on that trade. $120 is approximately 6% growth onto your account with just one trade. So keep that in mind when you're a new trader. Also, quickly looking at the trade planner, if you get 10 pips per day, your $2,000 account pretty much every 8 weeks, every 2 months doubles. Now, obviously, you're trading more lot size as your account grows. This is the power of compounding. It gets ridiculous after, half a year goes up. You can see you have $8,000, 16 weeks down, 17,000. and so forth. At the end of the year, obviously, it keeps compounding. You have 258,000. So keep that in mind as a new trader. Try to get a net 10 pips per day. If your goal is to make 50 pips a week, 200 a month, that breaks down to 10 pips a day, which means you can't have 30 pips of losses. That means you have to make 40 pips on the next trade or a series of trades to have your 10 net pips. So being very cautious and avoiding unnecessary trades, that are likely to lose or not make much, is one of the secrets to trading. Second secret is, I would say, for new traders to use our currency meter. Buy the strongest ones versus the weak. You can see the euro starts off very strong today. The percentage of currencies going up on the 15 and hourly chart are very high. Daily trend's up, the weekly trend shifts up at this point, and the monthly trend shifts from a very strong downtrend to uptrend. That's how powerful this move was. And one of the weakest ones was the Australian. So basically, today you'd want to start by trading the Australian, or by buying the Euro Australian. This is a 5-minute chart, but we're going to put it on the chart here, and you can see it exploded up here. On a 5-minute chart, the Euro Australian typically moves 3 to 3.14 pips every 5 minutes. If you're a longer term trader, you can put 15 minutes in here. And this will show you how many pips to put on a range chart to have it be similar based on volatility to whatever time frame chart you're looking at. 15 minutes, 5 minutes. 5 pips per bar is equivalent to a 15-minute bar. Range charts are vastly superior to time-based charts. So to bring up a range chart, click the chart button here. We'll put in EURAUD. Only put 2 days here because it has to go and get all the tick data. And if you wanted, when volatility slows down like it has recently, you might want to go from a 5-minute chart to a 15-minute chart, find out what the number of pips are, and use the 5R. That's 5 pips per bar range chart. R stands for range chart. Hit OK. It's going to go and get the tick data to calculate these range charts. And what's the benefit of that is when you have this kind of thing, you can really see the pullbacks. There's really two methods that new traders should focus on. Find the strongest currencies and either buy the breakouts or look for pullbacks or sideways range patterns. This one is a pullback. You can kind of draw your trend line over the bars coming down, and when it breaks that trend line, you get in. You can see it went up about 20 pips here. And if you don't know what you're doing, you could just simply look at this and get out whenever the trend line is broken. You'd be out here. And there's a couple patterns that you want to look for in trading range charts. One of them is a 3 to 5 bar pullback, which means red, red, red. The first green bar, you want to buy it when it goes 1 pip above the bar's high. So I've created something for educational purposes, a little script that puts these bars on the chart. It's called range bar, 3 bar buy sell. And when I add this to the chart, basically it's going to look for a certain number of bars down and then 1 green bar up. Typically I look for 15 to 25 pip pullback, and this just marks the bars so that we know where to look for. And after you find the currency that's going up, in this case, after a 3 to 5 bar pullback, the first green bar, you basically wait for it to go above that bar's high and you buy. So in this case, it didn't. Unfortunately, this is only a 2 bar pullback here. If you get a 3 bar pullback, it goes sideways, and then a 2 bar pullback, typically that's a pretty decent place to buy too. When I'm trading myself, I tend to buy this. I put my stop right underneath the bar's low. And the whole point of this is in trading, is to have small losses when you're wrong, and this is what you're risking. And you can see that you went up and then you had a red bar right there. If you put your stop right underneath each bar, you would have been out here. Your win is bigger than your loss. Let's move this down so we can compare them side by side. The key to trading is having small losses compared to your wins. New traders should really try to have 2 times bigger wins than losses. Now, for some reason, I'm having a hard time dragging this. There we go. So you can see this win was about 1.5 times bigger than what the loss was. Typically, you want to take trades that are more likely to give you 2 times bigger wins, especially as a new trader. But just notice that when you have a strong currency like this, when you have 3 to 5 bars down, the first green bar, you buy it when it goes above that bar's high. Obviously, this is in an uptrend. The pullback right here, here's another green one. And again, I only put this on there for illustrative purposes to let people see this. The deeper the pullback, the better. But then again, if you just simply buy this, put your stop underneath here, it goes up, move your stop underneath that bar's low, move your stop here. You can see small win in here, out here. You made 15 pips on there. This one you bought. It kind of went up here and went sideways. So you had a break even, small win, small loss in here at 43. Out at 48, not the biggest win in the world. So let's look at the currency meter to find some other examples of this. Later today, the yen became the weakest of all the currencies. The CAD, without a doubt, was the strongest. And it was anytime you have the currency meter pegged at 100, which is the highest it can go for at least 2 bars, those trends tend to continue for another 30 minutes to an hour and a half. So you had that here, and very soon after that, a little bit after 10, you had it in the CAD. The CAD was the strongest one. So you buy the CAD yen. Now sometimes the currencies jump so much. Let's bring this back up here and find out what a decent CAD yen range chart is. This is our ATR function, which you can go to add script, find the ATR, add it like this, click median and add it again. And sometimes the average and the median values are different, but on the CAD yen, 6 pips per bar is equivalent to a 15-minute chart. A 5-minute chart, because the volatility has dried up lately, is closer to 4 pips per bar. So if you want to trade something similar to a 5-minute chart, you would just simply put the CAD yen on here and then change it to 4 or 5 pips. I personally like to trade no smaller than 5 pips per bar because I like to buy 15 pip pullbacks. If I see 3 red bar is back, it's pulled back 15 pips. I know that automatically without thinking. So I'm going to change this to 4R just to show a certain pattern, because this is the appropriate number of, you always want to round up to the next highest pips when you're using it. So the CAD yen took off and it was really strong. And typically on a range chart, anytime it's in a very tight 10 to 15 pip range, up, down, up, down, up, down, you want to buy the breakout of the high. So this is another very low risk, range-based pattern. Your stop would be underneath that little sideways range right here. And a lot of times when news comes out, you get prices that gap up. This bar right here, you can see the range bar was bigger than 4 pips because during this bar it gapped, and so we close it. It gapped down, and then it gapped up to here. That was the next price point, and it's kind of going sideways here. Is the trend going to continue or not? If it goes sideways and breaks down underneath there, you don't take the trade. If it breaks out through the top, you do. And you can see that this went from around 80, 95 all the way up to 81.50. Went up 55 pips. And you can see another one of those patterns right here. 4 to 8 bar sideways rectangle pattern. 1 bar, 2, 3, 4, 5. This is a 5 bar pattern. So if you miss the trade back here, you have another entry right here. And typically when you see these strong currencies, they're going to work their way. The super strong currencies usually go to the 1.618 fib. So you can see if it stalled at the first one, I would get out, but it broke through there. Don't be greedy, get out at the 1.618 here at 44. And if you're really aggressive and you miss some of the earlier trades, or let's say you made a fortune on this explosive move here, here's your first 3 to 5 bar pullback, green, you're in right here at 37, and you didn't make much on that trade, but you can see the 3 bar or more pullback waiting for one sign of green is a good way to get into the trade. Now another one that was really strong, it was really weak throughout the day, but it was relatively strong at that 10 o'clock time. You wouldn't want to trade the euro or the Swiss against the yen because they've both gone weak against most of the currencies. The CAD was the strongest. The pound, which was, had decent strength before, was no longer strong. Between the New Zealand and the Australian, you can see the percentage of Australian pairs going up on the 15-minute chart. It shifted dark green. Unfortunately, the daily, weekly, monthly trends are very weak. So, and even the hourly trend was quite far down. So you can take a trade like that, but just be very cautious and move your stop up very quickly, move to break even once it goes 6 to 12 pips your way, because you're fighting a longer term trend that's down. But right at that time, it had a lot of strength. Second strongest after the CAD. So if you want to see the number of pips per bar, it's probably going to be 4 or 5. We can just use that. But Australian yen, 3.69, 3.65. So you can use 4 pips per bar on this too. Australian yen. And there's 2 methods I want to show for entry once you have the currency. The 4 to 8 bar rectangle pattern and then the pullback. So you can see in this case when it took off, you have your 3 down bars, your first green one, and you buy it when it goes 1 pip above the high. So you'd be in right there. I like to see more, marching down like this, deeper, bigger bars. But this is technically that bar pattern. You're in right there, your stop's a pip or 2 underneath the low, and you can see it just took off. The other entry, you can see 1, 2, 3, 4, 5 would be right here, with your stop underneath the low. And anytime I get into a trade, this is kind of the rectangle 5 bar pattern. Once it starts going up and then comes down against me and goes sideways like that, I'm moving my stop underneath those bars. So I'm going to, instead of risking maybe 10 pips, I'm only risking 7 there. And when it takes off again, because the Australian was on a strong downtrend, don't be greedy. If it stops right here, I get out of the whole thing. And when it hits a 1.618, I'm out. Because remember, the daily trend's down, the weekly trend's down, the monthly trend's down, and even after this explosive move up, the hourly trend is still down on the Australian. It's super strong down on the yen, though. It became much weaker. You can see, not quite as weak as the Australian. As it went on, it became less weak on the hourly. But regardless, the percentage of 15-minute Australian pairs trending up were super strong. You knew that, so you could buy, and you're out here at 92. So if you got into your first valid entry, which would be right here at 55, it went up, 35, 36 pips. The second entry was right here at 63, and you also have another entry if you missed both of those. 1, 2, 3, 4, 5, 6. This bar is kind of going sideways. A lot of times when I see a rectangle pattern like that that's pulled back and it's found support, it's higher than the previous sideways rectangle pattern, I'm going to get in this trade right here at 66 because my stop's going to be right here. I want a tighter stop so I can trade more lots, and if I'm right, I make more money. If I'm wrong, I lose a smaller number of pips. If I wait to get in right here when it breaks the high at 69 versus 66, I pay up 3 extra pips. That means I'm risking 3 extra pips on the trade. And the key to trading is small losses, big wins. If you have the opportunity to get in, because this is one of the 2 strongest currencies, the Australian was second only behind the CAD as being the strongest, then you really got to take the trade. Use your Fibonacci for your exits, and it's a very simple way for new traders to take trades. So to recap, use the currency meter, use the proper position sizing in the number of lots to trade, risk 1% if you're a brand new trader, 2% if you're a little bit more experienced. If I saw this trade and the Australian was trending up on the daily, weekly, monthly, then I would be trading maybe 3% risk on this, but because the Australian was so weak, I might only do 1.5% myself. I will trade smaller because my risk is higher. Always judge each trade based on its risk and its potential reward. The potential reward was huge in this because the percentage of Australian pairs shifting up were astronomical. Probably 80-90% of Australian pairs are going up. Yen pairs are pretty much going down against every other currency. And so this was likely to continue. It was likely to go to the 1.382 fib, probably 80%, maybe 70 or 65, 70% likely to go here. And so your potential risk is far less, your reward is greatly higher. Oops, let me show what the win versus risk is on this. This is your potential reward on that trade while risking a tiny amount. And anytime you can take trades that have very high winning percentage and are likely to give you 4 or 5 times bigger profit than what you risk, you got to pull the trigger. It's that simple. Trade this way until you learn some of our more advanced methods, and then you can look to do counter trend trades at the high if certain situations present themselves or if it goes outside of our containment bands. But this is a very easy way of trading for brand new traders, and it shouldn't take you more than 10-15 minutes watching these videos that I've done under this section. I'm going to continue to try to add at least one new video every week for brand new traders in very similar methods of this, and I might introduce some slightly more advanced concepts in future videos, but it's this